Have you ever looked at your bank balance and wondered, where did all my money go? You work hard, you earn, but somehow by the end of the month it feels like you have nothing left. Why? Because of financial mistakes. Costly errors that almost everyone makes, often without realizing. But don't worry, we will break down the most common financial mistakes people make and how you can avoid them, ensuring a more secure and prosperous financial future. Trust me, by the end of this video, you'll know exactly what's draining your money and how to fix it. Chapter 1. The Spending Trap. Living Beyond Means. The first and most common mistake? Spending more than you earn. This is a classic trap, especially with the rise of credit cards and EMI schemes. Easy EMI, no cost EMI. Sounds great, right? But if you're not careful, these small monthly payments snowball into a debt trap. How to avoid this mistake? 50-30-20 rule, a structured way to allocate your income. This simple budgeting rule divides income into three categories. 50% for necessities, covers essential expenses like rent, groceries, utilities, and transportation. 30% for wants, includes discretionary spending on dining out, travel, and entertainment. 20% for savings and investments, allocates money for emergency funds, SIPs, fixed deposits, and retirement plans. 2. Tracking expenses. Understanding where your money goes. Tracking expenses helps identify spending patterns and avoid unnecessary expenditures. Effective expense tracking methods. Mobile apps. Tools like Walnut, Money Control, and YNAB categorize expenses and set budget alerts. Excel sheets. A manual yet effective way to record and review spending habits. Envelope budgeting. Allocating cash into separate envelopes for different expenses prevents overspending. 3. Using credit cards responsibly, preventing debt traps. Credit cards are useful, but can lead to financial trouble if misused. Smart credit card practices. Pay the full bill on time. Avoid high interest charges by clearing the full balance each month. Avoid impulse purchases. Only buy what you can afford to pay off in full. Leverage benefits. Choose a card that aligns with your spending to earn cashback and rewards. Keep utilization low. Spending under 30% of your credit limit maintains a strong credit score. Chapter 2. Ignoring an emergency fund. Unexpected expenses are part of life. Medical emergencies, sudden job loss, or a major home repair. These can completely drain your savings if you're not prepared. Solution. Build an emergency fund. Ensure you have at least 6 months' worth of essential expenses saved in a liquid fund or high-interest savings account. This helps you manage unexpected financial crises like medical emergencies, job loss, or urgent repairs. Balance your investments. Avoid putting all your money into high-risk investments like stocks or cryptocurrencies. While these can generate high returns, they are volatile. Keep a portion of your wealth in safe and accessible financial instruments such as fixed deposits, money market funds, or liquid mutual funds. Automate your savings. Set up an automatic transfer to your emergency fund every month from your salary or primary income source. This ensures consistent savings growth without relying on manual efforts or willpower. Even a small regular contribution can build a strong financial cushion over time. Chapter 3. The Investment Blunders. Stock markets give great returns, but only if you invest wisely. Many people invest without research, relying on tips from random sources. That's a guaranteed way to lose money. Common investment mistakes to avoid. Investing based on FOMO, fear of missing out. Many investors rush into stocks, crypto, or other assets simply because they see others making money. This emotional investing often leads to losses when the hype fades and prices crash. Always do thorough research before investing. Putting all your money in one stock or asset class. Investing everything in a single stock, cryptocurrency, or even one sector exposes you to high risks. If that investment fails, your entire portfolio suffers. A well-diversified portfolio helps balance risk and reward. Ignoring mutual funds and SIPs, systematic investment plans. Many beginners overlook SIPs and mutual funds, thinking they are slow or less profitable. However, these options provide steady growth, reduce risk through diversification, and leverage compounding over time. Trying to time the market. No one can predict market movements perfectly. Waiting for the perfect time to invest often results in missed opportunities. Instead of timing the market, focus on staying invested for the long term. Not having a clear investment plan, investing without a strategy is like driving without a destination. If you don't have clear financial goals, You may take unnecessary risks or invest in unsuitable assets. Ignoring emergency funds and liquidity. Investing all your savings without keeping an emergency fund can put you in trouble during financial crises. Always keep at least 6 to 12 months worth of expenses in a liquid form like a savings account or liquid mutual funds.
How to invest wisely. 1. Start a SIP in index funds for long-term growth. Index funds track market indices like Nifty 50 or Sensex, offering stable and long-term returns with low costs. SIPs allow you to invest consistently and benefit from rupee cost averaging. 2. Diversify your investments across different asset classes. Don't put all your eggs in one basket. A good portfolio includes a mix of stocks for long-term wealth creation, debt instruments for stability, gold as a hedge against inflation, real estate for long-term asset appreciation. 3. Learn the fundamentals of investing before buying stocks. Before directly investing in stocks, understand key concepts like P/E ratio, debt levels, cash flow, and competitive advantage. Read books, take courses, and follow expert investors to build your knowledge. 4. Invest with a long-term perspective. Short-term market movements are unpredictable, but long-term investing in fundamentally strong assets leads to wealth creation. Patience and discipline are key. 5. Review and rebalance your portfolio regularly. Market conditions change, and so should your portfolio. Check your investments periodically to ensure they align with your financial goals and risk tolerance. Chapter 4. Not having insurance. The silent killer. Insurance is like a seatbelt. You don't realize its value until an accident happens. Many Indians either don't have insurance or buy the wrong insurance. What you need to secure your financial future. Check health insurance. A medical emergency can drain your savings in no time. Ensure you have a health insurance policy with a sum insured of at least 5 to 10 lakh rupees, depending on your location, lifestyle, and family size. In metro cities, where medical expenses are significantly higher, a larger cover is recommended. If you have elderly parents, consider a separate senior citizen health plan to cover their medical needs adequately. Term insurance. If you have financial dependents, spouse, children, parents, a pure term insurance plan is a must. Your cover should be at least 10 to 15 times your annual income to ensure your family's financial security in case of an unfortunate event. Term insurance provides high coverage at a low premium, making it the most efficient life insurance option. Don't mix insurance with investment. Your goal is protection, not returns. Avoid ULIPs and endowment plans. These policies combine insurance with investment, often leading to higher charges, lower returns, and inadequate coverage. If you're looking to invest, consider mutual funds, index funds, or other market instruments separately. For insurance, stick to a pure term plan. Financial security equals protection first, investments second. Ensure your family is shielded against life's uncertainties before chasing returns. Chapter 5. Not understanding taxes. If you're not planning your taxes, you're giving away more money than you need to. Tax saving strategies. Maximize your savings efficiently. Here are some effective strategies to help you save on taxes. 1. Maximize deductions under Section 80C. Under Section 80C, you can claim a deduction of up to 1.5 lakh rupees by investing in various tax-saving instruments, such as Check Mark Employees Provident Fund, EPF, a mandatory retirement savings scheme for salaried employees with tax-free maturity proceeds, Public Provident Fund, PPF, a long-term investment with a lock-in of 15 years, offering tax-free returns, Equity-Linked Savings Scheme, ELSS, a mutual fund investment with a short lock-in period of 3 years and the potential for high returns. National Pension System, NPS, a retirement-oriented investment that provides an additional 50,000 rupees deduction under Section 80C(c)(d)(1)(b). Tax-saving fixed deposits, a safe investment option with a 5-year lock-in, though the interest earned is taxable. 2. Claim house rent allowance, HRA, and leave travel allowance, LTA. If you are a salaried individual, you can reduce your taxable income by claiming HRA if you live in a rented house. Ensure you keep rent receipts and other necessary documents. Similarly, under LTA, you can claim travel expenses for trips within India once every 4 years, provided it is reimbursed by your employer. 3. Utilize deductions for medical expenses. Medical expenses can be significant, but you can claim deductions under various sections. Section 80D, deduction for health insurance premiums, 25,000 rupees for individuals, 50,000 rupees for senior citizens. Section 80DD and 80U, deductions for expenses related to the treatment of dependents with disabilities. Section 80DDB, deduction for treatment of specified diseases like cancer or neurological disorders. Optimize investments for tax efficiency. Instead of high-tax instruments like fixed deposits, consider tax-efficient alternatives such as index funds and ELSS. Capital gains are taxed at a lower rate compared to interest income from FDs. Tax-free bonds. Issued by government-backed entities, these offer fixed returns without tax on interest. Claim home loan benefits under Section 80C and 24B. If you have a home loan, you can claim up to 1.5 lakh rupees on principal repayment under Section 80C, up to 2 lakh rupees on home loan interest under Section 24B, additional benefits under Section 80EEA for first-time home buyers. 6. Save tax on capital gains. If you sell property or stocks, you can save tax on capital gains by checkmark investing in 54 EC bonds for property gains, reinvesting in another property under Section 54, holding equity investments for over a year to benefit from lower long-term capital gains tax rates. These mistakes can cost you lakhs or even crores over time. But now that you know about them, you can take control of your finances. Spend wisely and live within your means. Save and invest before you spend. Protect your money with insurance and diversification. Educate yourself. Financial knowledge is the best investment. If you found this video valuable, hit the like button and subscribe for more practical financial wisdom. Share this with your friends and family to help them avoid these costly mistakes. See you in the next video.